America's economy looks unstoppable. Wall Street is soaring, the S&P 500 keeps shattering records, and investor confidence appears unshakable. Markets are betting that the Federal Reserve, the world's most powerful central bank, will soon begin cutting interest rates. But beneath that optimism lies a dangerous paradox. The Fed now finds itself trapped in a tightening vice, caught between inflation, jobs, and financial stability. It's a dilemma unlike any it has faced before. For decades, the Federal Reserve has operated under a dual mandate to keep prices stable and ensure maximum employment. It's a delicate balancing act, taught in every economics classroom through the Phillips curve, the idea that low unemployment often comes with higher inflation and vice versa. Policymakers once managed that trade-off with relative confidence. But in today's post-pandemic world, that relationship has broken apart. After consumer prices spiked to 9% in 2022, inflation has since cooled to around 3%. Yet unemployment remains steady near 4%, effectively full employment. That sounds like success, but economists are warning of something deeper, a troubling decoupling between economic growth and job creation. Gross domestic product is rising strongly, reaching a 2-year high this summer while hiring momentum slows and wage growth cools. Inflation, though lower, has begun to edge upward again. The result is a new kind of trilemma, balancing inflation, employment, and financial stability all at once. Markets, meanwhile, are celebrating too early. Investors are pricing in rate cuts before they happen, loosening financial conditions, pushing up stock prices, and fueling a new wave of speculative risk-taking. If the Fed cuts rates too soon, it risks reinflating the same kind of bubbles that preceded the 2008 financial crash. But if it waits too long, the labor market could weaken further, threatening growth and jobs alike. This is the central bank's tightrope. Every move has consequences, and none are good. The roots of this problem run deeper than policy timing. The structure of the American economy itself has shifted. The labor force has grown due to immigration and higher participation rates. That expansion allowed the economy to keep growing without igniting wage-driven inflation. At the same time, new technologies, especially artificial intelligence and automation, have boosted productivity. The U.S. is producing more output with fewer workers. It's a structural change that explains why growth and job creation are now diverging. But it doesn't make the Fed's job any easier. Financial markets are thriving, corporate profits are strong, and asset prices keep climbing. Yet cracks are spreading beneath the surface. Valuations are stretched, leverage is returning, and speculative behavior is once again on the rise. The Fed can't ignore those warning signs. Inside the institution, there's growing recognition that its old framework may no longer fit today's economy. Some officials are quietly suggesting a shift away from the rigid 2% inflation target, a number that was never truly realistic, toward a more flexible range or an updated toolkit better suited to structural volatility. Behind those debates lies a broader question. Can the Federal Reserve adapt fast enough to preserve credibility in a world where its every signal moves global markets? This is not just a test of monetary policy. It's a test of trust. The Fed's decisions shape everything from mortgage rates to the cost of national debt. And in today's political climate, pressure on Chair Jerome Powell is mounting from every direction. If policymakers act too aggressively, they could trigger another financial bubble. If they hesitate, unemployment could rise sharply. Either way, the stakes are enormous, not just for investors, but for millions of Americans whose livelihoods depend on the Fed striking a near impossible balance. America's economy is decoupling. Growth, jobs, and stability no longer move together. Managing two of those goals was already difficult. Managing all three may prove the ultimate test of modern central banking. Consider the options. If the Fed cuts interest rates to support employment, inflation may resurge and asset bubbles could expand. If it keeps rates too high for too long, hiring will weaken, slowing the broader economy. And if it tries to fight financial excess directly, through regulation or liquidity tightening, it risks undermining growth and job creation in the process. This challenge is compounded by politics and debt. Tariffs and government borrowing are reshaping the financial landscape faster than the Fed can react. The return of broad U.S. tariffs, championed under the Trump administration, acts as a fiscal accelerant, raising prices on imports and reigniting inflationary pressure just as the Fed is trying to cool it. Unlike interest rates, tariffs are political tools outside the Fed's control, yet their consequences land squarely in the Fed's lap. Meanwhile, America's public debt has crossed $37 trillion. Interest payments alone now exceed defense spending, and they're growing faster than GDP. Each rate decision by the Fed can move tens of billions of dollars in government costs. If rates stay high, servicing that debt becomes dramatically more expensive, swelling the deficit and forcing Washington to borrow even more. If the Fed lowers rates to ease that burden, it risks weakening the dollar, driving capital outflows, and reigniting inflation through higher import and commodity prices. In short, the central bank is boxed in. Every lever it pulls has an unintended consequence somewhere else in the system. This is why the battle over monetary control between the White House and the Federal Reserve is escalating. The administration wants growth, the Fed wants stability. Each is pulling in opposite directions, and neither can fully win without hurting the other. The deeper issue is that the U.S. economy is running on contradictions. A strong labor market coexists with slowing productivity. Asset prices soar even as household debt climbs. Fiscal expansion fuels growth, but it also fuels inflation. The longer these contradictions persist, the greater the risk that one spark, a market correction, a debt scare, a geopolitical shock, could upset the balance entirely. For now, markets continue to bet that the Fed will manage a soft landing, but history suggests otherwise. Rarely does a tightening cycle end smoothly when speculation and leverage are this high. The Fed can manage liquidity, but it cannot manage sentiment, and sentiment is what drives bubbles. If the institution miscalculates, the cost could be severe. A premature rate cut could unleash inflation and financial instability. A delayed one could tip the economy into recession. The question isn't whether the Fed will move, it's whether any move can truly stabilize a system this complex. America's central bank faces not just an economic challenge, but a philosophical one: how to maintain confidence in a framework designed for a world that no longer exists. The global economy is fragmenting, technology is rewriting productivity, and politics is redefining the boundaries of monetary independence. The Fed's credibility and its ability to steer through this storm will define the next chapter of U.S. economic leadership. Getting it wrong could reshape not just markets, but the very foundations of American prosperity.